partner here at Eide Bailly in the Fargo Tax Department. And to kick off this Dealership Insight series on tax reform, I've got a couple people with me to help me out. So in the last year and a half since tax reform, or the Tax Cuts and Jobs Act, was released or was passed by Congress, we've been getting regulations from the IRS sporadically, and we're still waiting on quite a bit of regulation. So we just want to update everybody on where we are at and what items we saw throughout this last year in tax season that impacted dealerships, and talk through those items. Like I said, I've got two people from our National Tax Office joining me, both partners, and they are both specialists in specific areas, and they're going to walk us through the technical issues, and then we'll talk a little bit about what we saw over the last few months during tax season, and kind of from the dealership perspective, what we can look forward to. We're going to focus in on a couple areas that impacted the dealership industry the most, because those areas will be the biggest concern going forward. So I'd like to introduce Adam Sweet. He is a partner in our National Tax Office, and he'll be jumping in a little bit later. But first, Andrea Mao, a partner in our National Tax Offices who focuses on accounting methods, is going to walk us through the interest expense limitations and that code section that is new with tax reform. So I'll hand it over to you, Andrea.
Perfect. Thank you, Brittany. Well, as Brittany said, one of the unfortunate components of tax reform, there were a lot of tax savings provisions, but then there were also some offsets, some lost tax deductions to try to pay for the tax savings coming in. And unfortunately, one of them impacted the ability to deduct interest expense on a tax return. Historically, interest expense was generally fully allowable if you were in an active business, you were dealing only with U.S. parties subject to U.S. tax. In the past, we've had very few clients who've been subject to limitations on their ability to deduct interest expense. However, in connection with tax reform, they introduced a new limitation that applies regardless of entity type. So C corps, S corps, partnerships, sole proprietorships, doesn't matter. The amount of interest allowed as a deduction is limited to the sum of the business interest income, 30% of the adjusted taxable income, and then floor plan financing, which is of significant interest to this particular group. The nice thing is that for determining adjusted taxable income for the next few years, generally taxpayers are allowed to add back depreciation that was deducted on the tax return. So those of us generating large losses as a result of claiming bonus depreciation, that doesn't hurt us for the next few years because we can add that back into our taxable income. However, there is an important exception that was laid out in the proposed regulations, that depreciation that is included in cost of goods sold, so something that might be running through our inventory calculation, so to the extent that the depreciation relates to our production or resale activities, we are not allowed to add back that depreciation in computing adjusted taxable income. The impact of that, unfortunately, is that the higher we want our adjusted taxable income number to be as high as possible, because 30% of that is going to be the ceiling on the amount of interest that we can deduct. So to the extent we are not allowed to add that back, it gets us a slightly worse answer in terms of applying this limitation. And just to give you an idea of where we are, as Brittany mentioned, the tax legislation was passed at the end of 2017, and we are now in the process of receiving guidance from the IRS that provides additional detail on how to apply this. So the Congress passed a statute that provided just the basic outline of what the interest expense limitation is, and then the IRS is now coming in, and Treasury Department coming in and providing us with some interpretive guidance on this. So they released proposed regulations last November, and a lot of what we're going to talk about today relate back to what was stated in those proposed regulations. Those regulations are going to be finalized at some point, and they may contain different terms than the proposed regulations. Our hope as a firm was that those would be finalized sometime by mid to late June. However, last week at the American Bar Association tax section meeting, the IRS is now suggesting that they may not be finalized until the end of late summer or early fall. So we are now in a position where we may or may not get all of these final rules before extended tax returns need to be filed. And as a firm, we're internally analyzing this and trying to decide how we are going to recommend that clients proceed at this time. That was certainly an unfortunate piece of information that most of us were not expecting last week. There's 4 general groups of people who are going to be exempt from the interest expense limitations, but unfortunately, for this particular group, none of these exceptions are likely to apply. The small taxpayer exception only applies if you have less than $25 million in average annual gross receipts. Typically, dealerships do not. Electing real property trades or businesses, those are trades or businesses involved in operating, maintaining, renting, owning real property, and due to an exception in the proposed regs that we'll talk about in a few minutes, even a dealership entity like holding the property used in the dealership is not likely to qualify for that exception. And then farming businesses and utility businesses. The other interesting nuance here is that, as I said earlier, the interest expense limits apply regardless of entity type, so all entities are subject to it. However, mechanically, how the limitation is actually applied will vary depending on whether you're organized as an S corporation or a partnership. In an S corp setting, the interest expense disallowance is computed at the entity level and carried forward at the entity level. So the S corporation itself will be tracking any interest expense that has been disallowed in prior years. However, in the partnership setting, they compute the amount of the disallowance at the entity level. So the partnership will look at all of its adjusted taxable income and interest expense and decide whether it has a limitation at the partnership level. If it does, it is going to pass through that information to the partners, the individual partners. And the individual partners will be responsible for tracking and carrying forward the disallowed interest expense at their level. They will have to reduce their basis in their partnership interest by the amount of disallowed interest expense, but there are some rules that to mitigate that when the interest is sold. But probably the most challenging part of this is when a partner receives an interest expense disallowance from a partnership, they can only use that in the future if they have excess income from that specific partnership. So if I own interest in partnership A, B, C, and D, and partnership A has an interest expense limit, I cannot use the income from partnership B, C, or D to absorb that interest expense. So unfortunately, the result is that the specific activity that is generating the interest disallowance is also going to need to generate excess taxable income in the future in order for us to utilize the interest expense. Floor plan financing, as I said, is obviously a big issue for this group. Part of the negotiation process in passing the tax legislation was that there would be an exception that would allow dealerships to continue to deduct floor plan financing since it is a key component of their business. And floor plan financing is defined as indebtedness used to finance the acquisition of motor vehicles held for sale or lease that is secured by those vehicles. So we can only, floor plan financing cannot apply to copiers or to some other non-motor vehicle assets are not eligible for the floor plan financing exception. Motor vehicles are defined by self-propelled vehicles, boats, and farm machinery and equipment. The unfortunate sort of exclusions here are assets that we may think of as vehicles that are not self-propelled. So trailers, campers, construction equipment are not currently within the definition of a motor vehicle. So any financing related to those specific assets or those types of assets is not considered floor plan financing. And the difference is going to be floor plan financing is deductible in full. It doesn't matter if it's larger than your entire taxable income. We have no limits. We can deduct an unlimited amount of floor plan financing, but if we decide that the interest is not floor plan financing, then we are subject to the 30% of adjusted taxable income limit. So what would happen if you were a dealership that strictly sold trailers? None of your interest would be floor plan financing interest, so therefore you'd be subject to the limitation on 30% of your income, whereas if everything you sold was boats, you would have the ability to fully deduct your interest regardless of your taxable income. There have been a number of comments, both from practitioners, even from members of Congress, that this definition is a little bit narrow, that the intention was not to exclude these types of items because it's a challenge, for dealers that sell both RVs and campers. Some of the assets are eligible for the motor vehicle, some are not, which creates all sorts of challenging allocation problems. There have been several proposed corrections in Congress, but unfortunately none of them are moving anywhere right now. So it's possible that this definition will eventually be expanded. But at this time, we do not think that the IRS has the power to do it. So we would need actually an amendment from Congress on this. Brittany, I know you had some comments on how this worked with your clients thus far this tax season.
Yeah, sure, Andrea. So let's unpack this a little bit. What does this really mean for the dealership industry, or what did we see as we went through tax season in this last year? I think, first thing I'll say is this code section and this issue itself caused the majority of tax returns for our dealership clients to be extended, just because of the uncertainty that is out there and the clarifications we're hoping to get in the final regulations, and maybe some more taxpayer-friendly final regulations. And Andrea will get into that more as we move on. But just to think about the actual calculation of the interest expense limitations, with you get this floor plan financing interest exception. So with that interest exception, most of the dealerships we work with don't have any issues. They don't have any limitations on their interest expense, which sounds great. But what we ran into was that a lot of our dealership clients didn't need the exception. And you'll see when we talk in a few minutes about the trade-off for getting that exception was some loss of bonus depreciation. We have a lot of dealerships that were saying, I didn't want this exception. I wish I didn't have it because I really don't need it. Because 30% of EBITDA, which is that ceiling, is really a pretty high number for a lot of taxpayers. So first off, we saw a lot more taxpayers than I think maybe we originally thought that just didn't even need the exception. The next thing that we saw was that, with the definition of motor vehicles, like Andrea mentioned, we had a lot of dealership clients that were impacted by that definition. So I myself spend most of my time working with dealership clients, whether they be auto or truck or tractor implement or recreational vehicle. And when you think about those dealerships with the trailer inventory that are selling semi-trucks and trailers, having to separate out that interest expense, that floor plan interest expense would be a challenge and will be a challenge. So that was an issue we faced. The construction equipment industry, those dealerships not getting the exclusion could be a blessing or a curse, I guess. It depends on where, what your income and your interest expense is like for each individual taxpayer, but those were excluded. And so that was a bit of a surprise that we've had to work through. And then just, in the recreational vehicle space, we did have those campers, those dealers that sell campers that are pull-behind campers that aren't self-propelled. So that really, hopefully, if that can be expanded, would be helpful just from a logistical applying of the rules, and just also for some taxpayers that maybe need that floor plan exclusion.
Yeah, I would echo in general that I spent a considerably larger percentage of my time on 163J in general this tax season than I certainly anticipated. This has turned out to be the source of a lot of questions, both in the dealership and other industries more broadly. It's created quite a challenge for us. Mm-hmm.
And like Andrea mentioned, there are some exceptions to these 163J or these interest expense limitations, the small taxpayer exception, but that's if you have less than 25 million of gross receipts. And just the nature of the dealership industry, it doesn't take long to get over 25 million of gross receipts. So we just didn't see that benefit from anyone really being able to use that exception.
Mm-hmm. And I think one of the other questions that came up was, what is my floor plan financing interest in total? Because a lot of our dealers were receiving floor plan assistance or credits from the manufacturers, and we saw a lot of different accounting treatments of those across our firm, and even with anecdotally with others in the industry. Some dealers were treating that as a negative interest expense, so they were netting that amount against interest expense. And once they did that, their actual interest expense number became quite low because it was a significant credit. However, the IRS has issued guidance in the past that they believe that these are more properly characterized as purchase price adjustments. These are not interest expense offsets or reimbursements of interest expense. They're intended as a reduction in the purchase price of the vehicles to reach an agreed upon selling price. And part of the way that a lot of these programs work is consistent with that. Dealers will receive a flat amount of floor plan assistance regardless of how long the floor plan note might be outstanding. So they'll get $500 regardless of whether that floor plan interest is paid within 1 month, 6 months, 1 year. Doesn't matter, they get the same amount of credit. So it does tend to more closely resemble a reduction in the purchase price of the vehicles. And the change in treatment of those from an offset to interest expense to a reduction in the purchase price is an accounting method change. It is a change in the way that we are determining the cost of our inventory, and therefore we are required to file a Form 3115, an application for change in accounting method, in order to stop treating that as a negative interest expense and reclassify it as a reduction in the inventory purchase price. The silver lining here is that it should result in a favorable 481A adjustment or a favorable or deduction on the tax return, because when those who were treating it as an offset to interest expense were effectively reducing their expense, i.e. increasing their income in full at the time that they received the floor plan credit. However, if we push it through the inventory, that will not be recognized until the inventory items are sold. So to the extent that these credits are received for vehicles that are in ending inventory, we do not have to reduce our deduction in that year. We only reduce it when the inventory is ultimately sold. So we have had a few people start in on these 3115s, and we are seeing that those adjustments are favorable.
And I would echo that as well. Just in practice, I think this issue was highlighted because we were all taking a look at interest expense a little bit more closely. And one of the common treatments was to reduce your interest expense. And in a lot of circumstances, sometimes we had actually more interest credits than floor plan interest expense. So initially, maybe when we talked with clients about this limit a year ago, they thought, well, we don't have any issue at all. In fact, we have very little floor plan interest expense when we consider our credits. But in actuality, when we got into preparing the return and digging into the details, we realized that we needed to put those credits up into inventory to treat them properly. So that opened our eyes and presented some issues in some situations where those interest credits were a large amount. But also, like Andrea said, we filed a lot of change in accounting method. We are looking to file a lot of change in accounting methods to take advantage of this, to move those interest credits that are earned upon the purchase of that inventory into a reduction in inventory cost, and therefore deferring that income until it's sold. Of course, that is kind of a one-year deal, because each year you will be turning that inventory over. But it is a benefit you can realize, and accelerating or deferring income or accelerating deductions is typically a good thing from a tax perspective.
Yeah, it's usually the goal, although I was in a call this morning where it wasn't, but it happens. As Brittany alluded to earlier, not all gifts from Congress are free, and so by allowing dealers to deduct their floor plan financing in full, there was a trade-off, and the trade-off is the inability to claim bonus depreciation. And so 168K is the rule that outlines the bonus depreciation, or the 100% immediate expensing provision that was included in tax reform. And effectively what it says is that if the assets that you're looking to deduct, or the assets that you're trying to take bonus on, are used in a business that has had floor plan financing, if the floor plan financing was taken into account, then you are not allowed to take bonus depreciation. And so the two phrases that are highlighted there are the key items that practitioners and commentators have latched onto as needing additional guidance from the service to find out what they mean. So what does it mean for floor plan financing to be taken into account? There are a few different interpretations floating out there that we'll talk about in a second. And also, what is the impact of the has had language? So the has had could perhaps suggest that if we ever have floor plan financing, we are forever banned from claiming bonus depreciation, which would be an unfortunately harsh result for a lot of people. But as we said, the first issue that has come up is, what does it mean for floor plan financing to be taken into account? So for example, one of the theories that has been floated by commentators is, if the floor plan financing doesn't exceed interest income plus 30% of taxable income, floor plan financing hasn't been taken into account. So in other words, the theory is that I only need to use or rely on that floor plan financing deduction to the extent that my interest doesn't fit under the limitation that applies to everybody else, all other taxpayers. Unfortunately, we have proposed regulations under both 168K and 163J. Neither of them address directly or indirectly this particular argument. However, the Joint Committee on Taxation, or the JCT, late last year issued what they call the Blue Book, which is an explanation of the tax legislation, the legislative history, and their interpretation of what the tax reform provisions mean. Unfortunately, this is not something that we can rely on, but it is indicative perhaps of some of the theories that are floating out there that could potentially be included in the final regulations. And so the JCT Blue Book includes an example that says that to the extent that the floor plan financing does not exceed 30% of the adjusted taxable income, it is not considered taken into account for purposes of the limitation on bonus depreciation, meaning as long as my floor plan financing is below 30% of my adjusted taxable income, I can deduct my interest in full and I can claim bonus depreciation. Last week at the ABA meeting, the IRS specifically said that this issue would be addressed in the 168K, or the bonus depreciation regulations, which unfortunately are on the same timetable as the interest expense regulations under 163J, and likely to be released late summer or early fall. So the good news is we're getting an answer. The bad news is it's not exactly on the timeline that we were hoping for initially. And then the second interpretation that has been floated is whether taxpayers could perhaps elect to forego deducting floor plan financing. So if I have $10,000 on floor plan financing and $200,000 in potential bonus depreciation, I'm going to want the bonus because that gets me a better answer. And so there questions have been raised because the word if is used in the statute. Taxpayers and commentators have requested that they be given the opportunity to choose. Either I take my floor plan financing or I take my bonus, whichever one gives me the better answer. Again, the proposed regulations under the bonus rules and the interest limits do not address this argument. The Blue Book does address it in a footnote, but does not go into great detail on it. And last week, the IRS indicated that this provision is going to be included in the 163J final regulation. So under the interest expense regulations, we expect to see an answer to this question, but again, sadly not on the timetable we were all hoping for. And then the second issue we mentioned was the has had language. So the has had floor plan financing. And the concern here is that if the taxpayer has floor plan financing at any point in time after 2018, they'll never get bonus. So if I have floor plan financing on my 2018 return and never have it again, the fact that I claimed it on the 2018 return could potentially arguably ban me from claiming bonus depreciation in any future years. Again, the regulations are silent on this issue, but then the Blue Book came to the answer that we did not want. The Blue Book basically stated that once you have taken floor plan financing into account, you are banned from bonus depreciation in that tax year as well as all subsequent tax years. So it is really a one-time decision. Once you've decided to take the floor plan financing into account, you're done. There is no bonus depreciation in a future year. Most commentators, including the comment letter I've been involved with, we are suggesting that they take the opposite interpretation and make this an annual election. However, it remains to be seen how this will be determined, and this will also be in the final bonus depreciation regulations later this year. Not all bad news. We have been able to identify some potential planning opportunities that taxpayers can consider to try to mitigate these limitations. And the first one would be the way the bonus depreciation restriction is written, it only applies to quote unquote trades or businesses with floor plan financing. So to the extent that we have activities that are conducted in a separate trade or business from the one with floor plan financing, arguably those activities could be eligible for bonus depreciation. And we're hoping that the IRS is going to confirm, but our understanding right now is that the separate trade or business determination is based on the accounting method rules under 446. And those provide that to the extent that we have separable books, records, and financial statements, employees' names, accounting, we're accounting for the transactions at arm's length, we can argue that the taxpayer is engaged in multiple trades or businesses, therefore one of them can have floor plan financing and a different one can have bonus depreciation. So here's an example of how this could work. So in this situation, we have an owner group. They own one entity that owns the real estate. They own the building and the other related land improvements, and they also own the dealership. The dealership entity itself sells cars, but they also have a division that does leasing. As long as the leasing division has separable books and records and financial statements holding itself out to the public as a separate leasing business, that they are dealing with the dealership and the real estate entity at arm's length, arguably we could come to a situation where the leasing entity, the assets used in that business, could be eligible for bonus even though the dealership has floor plan financing, because the dealership is considered a separate trade or business from the leasing entity. And there is some fairly developed case law and IRS guidance on what it takes to be a separate trade or business, and it is a facts and circumstances analysis. So unfortunately, we can't give you a silver bullet solution here, but it is something that is worth exploring to the extent that the bonus, that you need both the floor plan financing interest and bonus depreciation. It may be worth considering whether we can structure around these issues. The other unfortunate part, as I alluded to earlier, real estate entities have the ability to elect not to be subject to bonus depreciation, or excuse me, to the interest expense limits. However, there is a special rule that disallows self-rentals or rentals of property to related parties if more than 80% of the fair market value of the real estate of the property held by the real estate entity is leased to the dealership that is under common control, greater than 50% common ownership. That real estate entity is not eligible to elect out of bonus depreciation. They effectively are not considered a separate real estate trade or business, which means, elect out of the 163J limit. So they will be subject to the interest expense limit. And the people I think that have been working through this issue thus far have determined that they need to make sure that that real estate entity, that the interest expense tied to those assets doesn't exceed 30% of the adjusted taxable income, or i.e. the rent that's received from the related party. So I have heard that a number of our clients have had to adjust those leases to make sure that the real estate entity had sufficient income to cover their interest expense. If we do have a situation where the real estate entity is leasing to an unrelated party, so perhaps it's a larger property, part of it leased to the dealership and part not, if they are eligible to make the election, they can elect not to be subject to 163J or not subject to the interest expense limitations. However, they do need to depreciate certain categories of property using the alternative depreciation system, or ADS. ADS provides a longer recovery period and a straight line basis for depreciating assets. The good news is here the IRS has told us we do not need to file a Form 3115, and we do not need to restate any prior year depreciation expense. All we do is simply extend the recovery period of the remaining depreciable basis as of 1/1/18 or whatever year we make the election to be exempt from the interest expense limits. And the recovery periods here are based on the year the property is placed in service. The biggest category that is problematic is the residential rental property. Prior to the Tax Reform Act, that was a 40-year ADS recovery period versus 27.5 for your general depreciation system. That was significantly reduced in the tax reform legislation from 40 to 30, but unfortunately for assets placed in service prior to 18, we need to switch the recovery period from 27.5 to 40. And the qualified improvement property, we'll talk in a minute about this. This is the property that was intended to be a 15-year recovery asset, but due to an error in the legislation is not. As of right now, it's 39-year property, so therefore it is subject to a 40-year recovery as well.
All right, so let's back up a little bit just to think about how this is really affecting our dealership clients. So the first thing, Andrea was talking about here was the loss of the bonus depreciation, and that is really what hurt and what really affected the dealership industry with that floor plan interest financing. So the floor plan interest financing excludes the dealership from taking bonus depreciation, but one solution that we used was to still utilize Section 179 depreciation. So if you're in a situation where you can take Section 179 depreciation to immediately expense all of the cost of those assets, fixed assets purchased in 2018, then you're fine, you get to the same answer. The problem is with Section 179, not everybody is eligible. You have to have a certain dollar threshold of assets added. It can't be more. Also, any passive shareholders or partners aren't able to utilize the Section 179. So if you've got a situation where you have a passive investor or maybe a family member that isn't actively involved and is a passive owner, that precludes that entity from taking Section 179 because their owners can't use it. So in those situations, 179 isn't available and you've lost the bonus depreciation. The other issue with Section 179 is that land improvements, think parking lots, parking lot lights where your inventory is, those are all costly items and are 15-year depreciable property, not eligible for Section 179, but would have been eligible for bonus if you weren't excluded from this with your floor plan interest financing. So, even in the entities and the taxpayers and clients that we could take Section 179, a lot of times they would have some substantial fixed assets added that were related to land improvements, because that is a large cost of your business that we couldn't get the accelerated depreciation on. And so then you're looking at 1 year compared to 15 years of cost recovery, which is a big deal. So we are patiently waiting for regulations. Like Andrea mentioned, we really thought that we would get them in June. So that's the communications I've been having with all of my clients and all of the other partners here until late last week when we found out that, it will be even later than we had hoped. So now we got to rethink that. So I'd encourage you to reach out to your preparer, your partner who you work with, to talk about, what action to take. It's going to be it's going to be a decision you have to make without a perfect answer. So we'll have to decide on each individual circumstance what's best there. Like Andrea mentioned, there are some suggested tax strategies that we have used and have been successful. That one being the separate trade or business argument, saying that if you had a taxable entity that had an operating dealership and a leasing company, if you can make the argument that that's a separate trade or business. We did see taxpayers do that successfully with a really great result there. Also, just the ability, if you have the same family group that is owning the real estate entity as well as the operating entity, but they're separate taxable entities, sometimes it's, doesn't matter to the individuals which entity buys that parking lot or pays for that, because if it's the same individuals at the end of the day, then it's almost better to put it in the real estate entity, because that real estate entity can still take bonus because they themselves don't have floor plan interest. So we did some planning around that. So it's important if you're looking at those kind of improvements to have those conversations, because there are some ways to plan around it. One thing that you might have been thinking as Andrew was talking about this and the impact of the interest expense regulations on real estate entities is, what about that small taxpayer election? If you have less than 25 million of gross receipts, you're not subject to these rules. And most real estate entities, most real estate rentals don't have more than 25 million of gross receipts. The problem is that 25 million of gross receipts is looked at on a control group basis. So if you've got the same people having ownership and control of both the operating entity and the real estate entity, both entities are subject to the rules. And the control group rules are complex, and the relationships between family members can be taken into account. So certainly something you want to talk with your advisor about, but it's just not as easy as saying, well, this entity itself doesn't have more than 25 million. The IRS is looking at everything at a control group level. So like I said, we extended a lot of dealership returns. We're waiting for regulations. We're going to have to address what we do. So I think it's just important that everybody, talk with their advisors about, what the best next step is and what makes the most sense from a timing perspective, from a tax perspective, and just finding the best solution that you can in the situation that you have.
I think that takes us to our first polling question.
Floor plan financing is indebtedness used to finance acquisition of motor vehicles held for sale or lease that is secured by the inventory so occurred.
We're going to hand it off to Adam next to talk about 199 Cap A. At least this is the more positive side of tax reform. Brittany and I got stuck talking about the downside. Now Adam gets to come in and talk about the positives.
Adam, you now have control.
Excellent. Thank you, Amy. So, yeah, Section 199A, I think probably everyone has heard something about it. It's the tax reform's answer for pass-through businesses. The corporate tax rate was cut down to 21% rate. It doesn't help most businesses in America, because most businesses in America, including probably most dealerships, are S corporations or partnerships. So we got Section 199A that gives you a 20% deduction if you have qualified business income. There's a whole bunch of hoops to jump through. Even after you have QBI, there's many, many hoops to jump through before you figure out what your final deduction is. But in preparation for this webinar, we were trying to think of a couple of topics that came up this filing season specific to dealerships and 199A. And one of the topics that came up was it is not at all uncommon that in a dealership, the owner of a dealership or the owners of a dealership may get certain types of payments from a manufacturer, and those payments may go directly to the dealership owner rather than through the entity. This could be for hitting certain sales goals or, who knows, certain other incentive goals that are reached by the business. Rather than the payment going through the entity, it goes directly to the owner on the owner's own return. So the question that came up is that QBI, qualified business income? It looks arguably it could be qualified business income, but some of it also is how has it been reported. And I think sometimes it was put on the Schedule C of an individual's tax return, which would make it look more like qualified business income. But if it's been reported somewhere else in the return, maybe looks a little less like trade or business income. But then secondly, the other problem is even if you call it qualified business income, the problem is all these other hoops that you have to jump through that I mentioned just a second ago. For instance, there's the limiting factors to consider for the 20% deduction, and those factors relate to wages. They relate to the depreciable basis in business property. You don't have any of that because you're getting you're getting a payment from the manufacturer that's reported on a 1099 to the owner. But the owner's not paying any wages, and the owner doesn't have any depreciable basis in business property because that's all at the entity level. So if you have taxable income above the phase outs, which is if you're married, it's above $315,000, it doesn't help you. Even if we call it QBI, effectively your 199A deduction could be zero on that amount because you don't have these other attributes, the wages and the UBI. So what do you do? I mean, so the two questions were, what do we do for 2018? And then what do we do for 2019 and beyond when we have a little more time to plan for? So for 2018, a couple of the ideas. One, potentially, could you run it through the entity and zero it out on the 1040? And this would just allow you then to use the entity's attributes, the W-2 wages and the UBIA. Or two, if you own enough of the dealership, 50% or more, perhaps you can aggregate this payment you get from the manufacturer with the dealership income that you receive from the K-1. But the one thing to consider there was apparently that this income, again, this income that came directly to the owner, there may be differing treatments out there on whether that was subject to self-employment tax or not. It may have been that some people were not treating it as subject to self-employment tax. That's probably a tougher position to take if you're going to be treating it as qualified business income and aggregating it together with this other entity level income. So something to consider, that you could be paying some more self-employment tax on that income if you choose to aggregate it. Generally speaking, the 199A benefit, particularly for higher income people, the 199A benefit will outweigh any potential SE tax, additional SE tax bills due, but something to consider. And then for 19 and beyond, it would seem really best practice is to route this money directly through the entity, so that rather than have these payments go directly from the manufacturer to the owner, have the payments go to the entity. My understanding, this could change, you'll have to consider this because this could change some of the economics of the dealership. You know, there could be employee bonus pools and so forth that are affected by these amounts. So this could change the economic deal. But for 199A, if you put it through the entity, it should make it a lot easier to claim the deduction. One other thing that came up with dealerships, it's not at all uncommon in the dealership space, really, for most businesses, to have OpCo and PropCo. So the dealership, the operations is housed in one entity. Let's say it's an LLC. The real estate is housed in a separate entity. You do that for asset protection purposes, for state law or regulatory purposes. Not at all uncommon. There's a special rule that says the rent paid by the real estate entity, or the rent paid by the dealership entity to the real estate entity, that rental income that flows out of the real estate entity, is deemed to be qualified business income if you have 50% or more common ownership and the dealership is the exclusive user of that real estate. So just something to pay attention to. It's just an automatic. I just draw a big circle around the dealership and the real estate entity, and that whole thing is a trader business, and all of it is qualified business income. And the interesting thing is it uses the related party rules, so that you could even have, this next slide illustrates it, but you could have minority partners in one entity who don't own any piece of the other entity, and those minority partners could still get QBI treatment if there's enough common ownership between the two entities. So it's an interesting quirk, maybe intended, maybe unintended. It's surprising maybe because, like in this slide here, the third party doesn't have any ownership in the dealership. They just have some ownership in the real estate entity, yet it appears that they get QBI treatment coming out of the real estate entity. And then finally, the aggregation. Aggregation is the idea that if you have multiple trades or businesses, Andrea was talking about for floor plan financing purposes, it may be advisable to set up separate trades or businesses underneath your dealership, your leasing activity, and make that separate and apart from perhaps your other business activities. 199A is also a trader business by trader business concept, so that you test 199A, even if one entity, if you have multiple trades or businesses, you test each business on its own for 199A. But if you have enough common ownership and enough relatedness between those businesses, you can aggregate those together and test them as based upon an aggregated group. Why would you do that? Well, it's more efficient, one. Two, you can share the attributes, the W-2 wages from one business, you could share it with the other business if you're limited in one business versus the other business. Specific to dealerships, one of the factors in the proposed regulations, actually in the final regulations for allowing aggregation, is businesses that are providing common products and services. You would think that if you have separate, quote unquote, separate trades or businesses under your dealership entity, there may be this common factor there, and that may allow aggregation. And you can also do it either at the entity level or at the individual level. And then finally, just some reporting and compliance considerations for those of us that have extended returns. An RPE is a relevant pass-through entity. It's really, think of it, if it's the dealership, it's the S corporation or the partnership. You have to put all of the necessary 199A information has to be reported on the 1065 and on the K1, and then reported to the owners. If any portion of that is left off, it's presumed to be zero in the hands of the owner, so that the owner results in no 199A deduction. So it's just very important that all of the necessary information for computing the 199A deduction is included on that K1, because the IRS is going to come in and say, if it's not there, it's going to say, well, 199 is 0. So it brings us to our second polling question. True or false, aggregation, which is under section 199A, is now allowed either at the entity or individual level.
And as you're answering that, I'll just comment, on what we saw during tax season was just a lot of benefit from 199A due to the nature of dealerships and the high amount of wages that you pay because you are so people intensive. That 50% of wage limitation didn't come into play. With the aggregation, you were able to group a lot of entities. So really getting that deduction on all of that dealership and related entity income was a benefit, and in a lot of cases reduced the effective tax rate almost 10% from pre-tax rates to current tax rates with QBI.
Yeah, that's a great point. The effect, if you're in the highest marginal tax rate, which is 37%, if you get the full 199A, it brings your rate down to officially to 29.6%. So huge benefit to anyone who's eligible.
Yeah, in 2017, you would have seen a highest tax rate of 39.6. So huge difference and a lot of tax savings for our clients there.
All right, so the results there were 86% true and 14% false. Right?
In general, the answer is it's true. You can either do it at the entity or the individual level.
We'll try keep moving here. We've just been having so much fun so far. We're falling behind here. The next topic we're going to discuss is bonus depreciation in the Section 179 deduction. So bonus depreciation, as most of us know, was moved to 100% for qualifying property acquired and placed in service after 2017 through the end of 2022, and then is scheduled to phase down over the next few years. There's 4 general requirements for property to be eligible for bonus depreciation. So it must meet the definition of qualified property. So it has to be recovery period of 15 years or less. Certain software films was an additional category of property that is eligible now. Probably the nicest extension of bonus here was that it now applies to certain types of used property. Not all used property acquisitions will qualify, but we have found that many do. So you no longer need to go out and buy something brand new in order to get bonus. You can potentially take bonus on used property. It must be placed in service during the bonus window that was on the prior slide, and it has to be acquired after September 27, 2017. This is a chart just summarizing what happened with the improvement property. So prior to tax reform, there were 4 categories of improvement property: leasehold improvement, retail, and restaurant property. Those 3 were eligible for 15-year recovery and 50% bonus depreciation. Qualified improvement property, which is an interior improvement to a non-residential structure that is non-structural and not certain types of improvements, was 39-year property but eligible for 50% bonus. There was a window at the end of 2017 where all of those assets continued to have the same recovery periods but got 100% bonus. However, effective as of 1/1/18 under the new tax legislation, qualified leasehold, retail, and restaurant property are eliminated. Those categories no longer exist. Congress's intention was to assign a 15-year recovery period to qualified improvement property because that was the broadest, what they consider to be the broadest definition. So the largest potential group of taxpayers could qualify. They were going to assign a 15-year recovery and provide 100% bonus. However, when it came time to actually draft the legislation, someone forgot to include that. So unfortunately, in the absence of that provision, that property is 39-year property and is not eligible for bonus because the specific exclusion that allowed bonus in the prior to tax reform was also removed. So unfortunately, we have no choice at this point but to treat that as 39-year property with no bonus. This is because it is an error in the statute. It actually requires Congress to fix it. The IRS is powerless in this situation. They have looked at their options, and unfortunately, they are none. So we are in a position now where we need Congress to come in and correct this for us, and unfortunately the correction is going to require a 60% majority, which is a difficult feat these days, is to have a piece of legislation get 60% support. The 179, the dollar limits here increased up to $1 million with the phase out above $2.5 million. They also expanded the definition of qualifying real property to include roofs, HVAC units, and things. And the nice thing about this, so you see qualified improvement property, as Brittany alluded to earlier, is not eligible for bonus, but it's still eligible for 179. If you meet the definition of qualified improvement property, you can still take an immediate deduction under 179. Roofs and HVAC systems are often not eligible for bonus because they are exterior and not interior. So 179 provides a good opportunity there to be able to deduct those in full. And the final question, the slide here really is just how people are making their decisions, because right now 179 and bonus could both potentially result in immediate full deduction. And so the considerations that we're having taxpayers look into are, what are the categories of property I just mentioned, the roofs and HVACs that are eligible for 179 but not bonus. Obviously, we'll want to take 179 on there. However, 179 is subject to the dollar limit. So once your qualifying property exceeds $2.5 million, you start reducing your $1 million benefit. And then there are certain taxpayers that are not eligible for 179, as Brittany said earlier. Certain trusts, certain business activities are not eligible for 179. But then the flip side of that is the bonus depreciation limits. So our entities with floor plan financing or businesses with floor plan financing are not going to be eligible for bonus. I don't know, Brittany, if there's anything that you saw this season that
the only thing we saw, we saw some qualified improvement property. A lot of times with the manufacturer requirements for the facilities and remodels being done, a lot of that would be qualified improvement property. So that, that not qualifying for bonus was an issue, although the floor plan financing interest issue kind of trumped that. So, but we did see it a little bit in real estate entities, and I think we hope it'd be beneficial if we get that qualified improvement property to a 15-year life eligible for bonus. That would make things easier.
Yeah, and unfortunately right now we have not heard much on the timetable on that specifically, but the last I heard, the best case scenario was that Congress would look at that again also late summer to fall. So apparently that is the time we'll be seeing a lot of things. Then we're going to flip it back to Adam here to talk briefly about opportunity zone.
We will move quickly here. We got 5 minutes left. Opportunity zones, much in the news. Quickly recap, opportunity zones, the basic idea is if you sell a capital asset and have qualified capital gains, if you invest it into an opportunity zone through an opportunity zone fund, you can defer that gain, and then you can also, if you do everything right, at the end of 10 years, you can then exit the fund, sell your interest, and all of your post-investment appreciation could be tax-free. Lots of nuances and detail that we won't get into today, but basically this chart kind of quickly outlines the benefits. You get gain deferral in 2019. If you hold your investment for 7 years, you get a 15% free step up. 2026, unfortunately, you have to recognize your deferred gain no matter what, but if you've had the 15% step up, 15% less of the gain will be recognized. And then in year 10, if you did everything correctly and then sell your fund to interest, you can exit and not pay any tax. So I'll leave it at that. If there's interest or questions, please reach out separately after this. I mean, I'm not doing this not doing the provision justice with this, but I think this gives a basic synopsis of it. So polling question 3, eligible capital gains, I didn't hit this point, but eligible capital gains must be reinvested into a fund within 180 days under the Opportunity Zone program. True or false?
I think the important thing to realize is that the Opportunity Zone the Opportunity Zone funds are more prevalent than I would have maybe originally expected. There's a lot of Opportunity Zones out there. If you've got capital gain property that you're selling, you certainly should look into this because I think it might be easier than it sounds to maybe get this benefit.
That poll is closed and it was 94% true.
And that's correct. You have 180 days, similar to the 1031 exchanges. So that brings us to 1031 exchanges. There was a change to 1031 exchanges, that you can avoid recognizing gain if you roll your gain into like-kind property. With tax reform, 1031 exchanges now you can only do it with real property, no longer with personal property. So I guess I push this to Brittany. What was the impact into the dealership space that you can now no longer personal property?
We had some some dealerships that maybe were trading some of their own vehicles in, and so this loss of the like-kind exchange treatment would have impacted them a little bit. But with Section 179 and bonus depreciation, if they were eligible for that, kind of got you to the same spot. So not a real big impact to dealerships. A lot of their customers ask them questions, so sometimes we ask more questions about that, just how do they respond to their customers, as the customers were worried about what benefit they might lose. And then the last item we'll just go over quickly, which is really just an irritant into tax season, was this parking expense disallowance. You know, tax reform came out, looked like parking expense that you paid for your employees was going to be disallowed, and what we immediately thought was this is only really going to impact people that are paying for parking and parking ramps, things in downtown metro areas. So we really didn't expect this to affect dealerships much, but then December came around, December 2018, and the regulations came out, and it was evident that the IRS expected that any expenses incurred to provide a parking spot for your employee was subject to this disallowance. So really we had to look into that a little bit later than we thought. And during tax season, we talked with a lot of our dealership clients about this, and it ended up kind of being a great big nothing for a lot of them. But what really you need to look at is the two exceptions to this rule. And Amy, can you move my slide? I'm not able to. Okay, so basically the rule says you need to look at the expenses you're incurring for parking, whether that be rent or maintenance on your parking lot, and that part of those expenses that are for parking of your employees would be non-deductible. The exception is that if you don't have designated employee parking, or less than 50% of your parking spots are used by employees. So we found out a lot of our dealerships didn't have designated employee parking, or if they had it, they decided that they would take that down. And then they also looked at their parking lot, which is a little bit harder with the dealership industry, because most other businesses aren't displaying their inventory out on their parking lot like you guys are. So you've got some inventory display and some parking lot for your employees and customers. So really you got to look at what part of the parking lot doesn't typically have inventory on it. Just look at that, and if less than 50% of those spots are used by employees on a typical day, then you don't have to include any of those expenses as non-deductible. By the time you look at all of the service vehicles, the vehicles that customers have in for service, and any customer parking or any open spots, which would be considered customer parking if they're typically vacant, most dealerships said that their parking lot was less than 50% used by employees. So with that fact of less than 50% used by employees and no designated employee parking, we then were under the exceptions and did not need to treat any of those expenses as non-deductible. There were a couple dealerships that couldn't follow that fact pattern. So you certainly got to ask the questions, and you certainly got to go through, make sure you qualify for the exceptions. But at the end of the day, it didn't really end up impacting that many of our clients, which was good, but still an additional irritant throughout the tax season and something you need to address. That about wraps it up. I will hand it back to Amy. Appreciate all of you guys attending. Certainly reach out if you have any questions, and stay tuned for more guidance.
Here is a list of all our webinars for May. Awesome. Well, thank you, Adam, Brittany, and Andrea, and we hope everyone has a great day.
Thank you.